Hey everyone, and welcome back to another video for today. So in today's video, I do want to touch on 4, maybe even 5 cybersecurity names. You might not have known, but ransomware attacks blocked by Zscaler Cloud rose 146%. This is the sharpest spike observed in the past 3 years. Public extortion cases jumped by 70% based on data leak site analysis. Data exfiltration volumes have increased 92%, and manufacturing, technology, and healthcare were the top targeted industries, and the oil and gas sector experienced a 935% increase in attacks. If we look here at the top 15 countries based on share of ransomware attacks, you can clearly see that the United States sits at 50.8%. Now in this video, we're going to talk about Palo Alto Networks, which is the giant with the firewalls and cloud security, CrowdStrike, they excel in endpoint protection and threat intelligence, Zscaler, Sentinel One, and Fortinet as well. And so let's start off with Palo Alto Networks. That's the one that just reported their quarterly figures. Stock is up 4.7% on a Tuesday when filming this video. This is a company worth $117.6 billion. As you can clearly see, over the past 5 years, this is a stock that has done quite well. It's up 301%, and year to date, it's now up 2.1%. Well, cybersecurity stocks, believe it or not, have not been performing that well. Some have, but a lot of them did not perform very well. Most of them are very, very expensive. If we purely look here at trailing PE, EV to sales, EV to EBITDA, or even forward, right? Forward PE, price earnings to growth, most of the cybersecurity names are extremely expensive. Now, most of them are also expected to grow nicely over the next couple of years, whether it's revenue or EPS, but it does seem like the market is putting a pretty high premium on cybersecurity names right now. So let's talk about all of those names in this video. If you enjoy this type of videos, hit all the buttons, would really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. And also special thanks here to Fiscal.ai for sponsoring this video. Fiscal.ai, previously FinChat, is of course a stock research platform that you've seen on this channel time and time again, and especially during earnings season, this is an extremely useful one. Because as you've just seen, I went to view transcript. We have here the full transcript of the earnings call, the earnings report as well, and the presentation. Some companies have presentations, some others don't, but here you don't even have to go to the company's investor relation website. You get it all right here. And then of course, our trusty AI summary. So for the quarter, revenue increased 16% year over year. Their fiscal year 25 did end. So for fiscal year 25, revenue increased 15% to $9.2 billion. Next generation security ARR grew 32% year over year to $5.6 billion. And RPO, remaining performance obligation, did grow much, much faster than revenue, 24% growth to $15.8 billion. If you remember, a year or so ago, they switched strategy to a more platform style, something that CrowdStrike has been doing for quite a while. They said that the company platformization strategy is resonating with customers who are seeking integrated security solutions. This is evident in the strong growth of next generation security ARR. If you're not aware, Palo Alto is also going to acquire CyberArk, another company, for about $22 billion. I think it's $20 billion. And here on Fiscal.ai, you can actually ask specific questions. So what did they say about CyberArk? And they're going to go through all of the transcript, all the reports to see if they mentioned anything about the acquisition. And of course, they did. So they believe, Palo Alto believed, the identity market is at an inflection point due to the rise of agentic AI and mass AI adoption. They believe that identity security will be crucial in the coming years. CyberArk's reach extends to over 8 million privileged end users and over 50% of Fortune 500. Palo Alto believes it can deepen CyberArk's PAM penetration and target a large base of global IAM users and machine identities. They also see quite a lot of upside, so Palo Alto believes the acquisition will accelerate its mission to double the value of the joint businesses over the next 5 years. Palo Alto is also targeting adjusted free cash flow of over 40% for the combined company in fiscal 28. So that's about 2 fiscal years from now for Palo Alto. Now, if you look at how Palo Alto generates revenue, again, this is all powered by Fiscal.ai. If you use my link, you'll get 15% off. New users will get Fiscal Pro for free for 2 weeks. So you can try it out. No commitment necessary. And I do want to thank everyone that has been using my links. I really, really appreciate that. So as you can see, total revenue did accelerate over the last couple of quarters. The majority of the revenue does come from subscription revenue. Then we've got support and product revenue. All in all, we've also seen that remaining performance obligation did accelerate quite a lot in this quarter, up 24.4% year over year. Then looking at gross profit margin and free cash flow margin. Gross profit margin, this is in the last 12 months, so we get a bit of a better picture. And this is not including the most recent quarter, because unfortunately, it does take a day or two until we get the updated numbers when it comes to gross margin, free cash flow margin. For key performance indicators, these are usually updated 15 to 30 minutes after the company reports, but it's about the same number right now, 73.6%, free cash flow margin 33.8%, and as they said, they target above 40% adjusted free cash flow margin for fiscal 2028. Looking at operating margin, that has been stable at around 11.2% for the last couple of quarters. Then for this quarter, as you can see, revenue came in better than expected. Remaining performance obligation also better than expected. Next gen security ARR better than expected. And the same here for diluted earnings per share, growing 27% year over year. As you can see, they are targeting above 40% free cash flow margin for the combined company in fiscal 28. The acquisition of CyberArk is expected to close in the second half of fiscal 2026. And this is the guidance that they are giving us for Q1 fiscal 26, which is next quarter for them, and fiscal year 2026 as well. So you can clearly see that, well, next-gen security ARR is growing much, much faster than total revenue, but that's great. Remaining performance obligations still expected to grow 23% year over year. So definitely they're seeing a lot of traction. We're already seeing here adjusted free cash flow margin between 38 to 39% for fiscal 2026. And if we go back to the last 12 months, well, that's of course much lower than that. Moving on to the next one, that's SentinelOne, much smaller of a company worth $5.6 billion. Performance-wise has been horrible over the last 3 years, over the last 12 months as well. And year to date, same thing right here. Again, this is a much smaller company compared to all the others that we're going to cover in this video. Here as well, if you look at the forward PE, still very expensive. And you would say that, well, this is a company that should be growing much faster because it is smaller here as well. And it's also a company that should have maybe taken advantage from the CrowdStrike fiasco a year ago. But what we've seen with CrowdStrike, and we're going to talk about that in a second, is that, well, CrowdStrike is just such an amazing platform that even such a huge fiasco last year couldn't really stop the company from growing that fast and didn't really help SentinelOne that much. But that said, SentinelOne is still expected to grow fast, I would say, in the next coming fiscal years, including fiscal 26. We actually see small acceleration in growth in fiscal 27, gross profit margin that has been improving quarter after quarter, and the same thing can be said here with free cash flow margin. Of course, as you can see, in Q1, they're yet to report their next quarterly figures, 5% for the last 12 months. We're talking here about over 30% for the likes of Palo Alto, and you will see with the others, it's up there as well. So there's still a long way to go with regards to SentinelOne. Profitability-wise also, still a long way to go. Operating margin for this company is negative 38.4%. But right now, since this is still a young company, all things considered, still very small, maybe we should give them a little bit more time, because right now, if you look here at customers with over $100,000 in ARR, that's still growing above 20% consistently quarter after quarter. If you look at annualized recurring revenue, that's also still growing above 20%, although the growth rates have, of course, come down. So you don't want to see this continue to go down until it hits single digits, but this is still a fast growing company. RPO over the last 2 quarters have seen an acceleration in growth. So October quarter of 2024, that increased 25%, then 30.5%, and the last quarter was 33%. Let's see what happens in the upcoming quarter, because this is definitely a very, very good trend after seeing these trends right here. Now, of course, what you want to see from a company like Sentinel One is them continue to grow quite quickly for many, many years to come. Them showing us maybe big wins in the upcoming quarters. Because yes, the cybersecurity space is definitely growing. It's a highly, highly competitive space, right? We're basically talking about 5 players here. Of course, not all of the 5 do compete directly one with each other. Sentinel and CrowdStrike, yes, you might say that they're competing one with each other here. Palo Alto Networks here as well. But it's such a big market that is growing so fast. You would think that a company of this size, which is Sentinel One, that they would capitalize on that momentum. That's the problem right now. That's also why the stock has gone down so much. But maybe that's an opportunity. Maybe that's an opportunity right now for long-term investors. Moving on to arguably one of the highest quality names in the cybersecurity space and also one of the most expensive ones, and that's CrowdStrike. CrowdStrike has performed very well over the last 5 years. Over the past 3 years, it's up 121%, and year to date, it's up 20.3%. And here as well, you can see a small drawdown here of 18% since the peak this year. This is a company worth $106 billion. Now, here as well, like I said, super, super high premium from the market. This is a company that has been growing fast and still expected to grow fast in the future. Now, again, not just because I'm making this video right now, of course, does not mean that you have to jump in those names the day after or an hour after that. No, I'm just here to provide some information about those companies. I do think that those companies are definitely quality ones, but even with great companies, like I said, with the trade desk, there is a correct price to pay for all of it. And if we're looking at CrowdStrike, super high quality business, but here as well, you can see that total revenue still growing nicely, right? But growth has been decelerating quarter after quarter for quite a long time. Now, they did tell us the following thing. For Q2 expectations, the company's CFO stated that they expect the sequential net new annual recurring revenue growth rate in Q2 to be at least double what it was in the same period last fiscal year. This signals a positive shift and an anticipated reacceleration of growth. Management expressed strong conviction in a reacceleration of net new ARR in the second half of fiscal 26. This confidence is based on the success of the Falcon Flex model, new product momentum, and strategic realignment plan. So, of course, we are seeing this. For us to be maybe more comfortable paying that premium, we should be seeing a little acceleration or reacceleration in growth in Q2 and in the second half of their fiscal year. Now, that said, RPO still growing 44.7%. Annual recurring revenue still growing 21.6%. Margin-wise, gross profit margin, we've been around 74-75% for quite a long time. Free cash flow margin did start to drop a little bit. We do have some negative impact from what has happened last year here as well, but that should definitely, the trend should definitely recover moving forward. And then operating margin, as you've seen previously with the trailing PE and all of that, operating margin is negative 4.4%. Yes, even here with a company worth $100 billion. And that's why I keep saying great companies, that's fine. But even with great companies, sometimes the stock can go up for a long period of time, but there will come a moment where the market will be like, you know what, maybe it's time for a 50% haircut. And that's when you should be ready to act accordingly. I'm not saying that CrowdStrike will experience a 50% haircut, but a company like this cannot continue to be not profitable. Of course, it still generates free cash flow, which some might say is way more important than just earnings. I could make the case for both of it. But CrowdStrike, it's a company that has always traded at a high premium. But there will come a time where the market will probably say, you know what, great company and all, but seeing how, there are maybe some better opportunities out there in the market, maybe it's time to lower the prices, right? Maybe it's time to lower the prices, especially if the market is not happy with the reacceleration in growth. Maybe they will show reacceleration, but it might not be enough. Just like we've seen with the trade desk. It was a very good quarter, just not enough to justify the price. Moving on to the next company, and that's Fortinet. Fortinet is a company worth $61.8 billion, and here you're not really paying such a high premium compared to all the others. Trailing PE 31.5, forward PE 30.6, margin-wise, very, very good. Okay, very, very good. I know it's not a sexy name like a Palo Alto or a CrowdStrike or even a Sentinel One, but Fortinet, despite the stock, well, still being up 206% over the past 5 years, over the past 3 years, 54%, over the past 12 months, only up 4.3%, and year to date, still down 17.7%. That happened, well, more recently, as you can see, their reported earnings. Was a good quarter. Market was just not happy with the guidance, with the expected growth. But as you will see, again, good quarter, all in all, growth, good commentary across the board, as you can see right here. And they even raised full year 2025 billings guidance midpoint by $100 million. Might not be much, but it's better than nothing, right? It's better than nothing. With all that said, Fortinet, in my opinion, deserves a little bit more credit. Yes, revenue growth might not be above 20%, but we're still close to 15%. If we look at free cash flow growth, for example, for the last 12 months, 29.2%. For fiscal 25, that's only expected to be 6.3% year-over-year growth, but then above 14% year-over-year growth in free cash flow for the next 2 fiscal years. That's quite good. Remaining performance obligations is, of course, not growing as fast as the others, but here we've also seen a slight acceleration in growth, growing 12.2% last quarter. Total billings, this one has also seen a nice reacceleration in growth for the last 1, 2, 3, 4, 5 quarters right now. Let's see what happens in the next one. As for margins, I mean, the price that you're paying for Fortinet for gross profit margins here of around 80%, operating margin and free cash flow margin pretty close one to each other, 30 to 32%. I mean, we've just seen all the others. We've just seen the price that you're paying for all the others. Of course, you're paying a little bit more because they're growing faster, but this is a profitable company, right? This is a company that is still growing, that has high margins, and it is profitable. And yet you get the chance to buy this stock at a cheaper valuation than, maybe even a Zscaler, for example. But we'll touch on the Zscaler as a bonus pick in a bit. But yeah, Fortinet, in my opinion, is one of those forgotten names in the cybersecurity space because it's not as sexy as a CrowdStrike, Sentinel One, or Palo Alto Networks. Moving on to the last one and the bonus pick here, Zscaler. So Zscaler is up 115% over the past 5 years. This is a company worth $43 billion. As you can see, PE for the last 12 months, non-existent. PE for the next 12 months, 79.5%. This is a company that, of course, has been growing quite rapidly and still expected to grow fast over the next 2 fiscal years. EPS, not that much. Now, as you can see here, margin-wise, gross profit margin 77.5%, free cash flow margin 30.3%. But if we look at net operating and EBITDA, still negative over the last 12 months. Now, if we go and look at what has happened last quarter, which they reported May 29th, revenue increased 23% year over year. Calculated billings increased 25% year over year. Deferred revenue increased 26% year over year. Cash provided by operations was $211.1 million or 31% of revenue. Customers with ARR of equal to or above $100,000 increased 15.1% year over year. And here as well, the trend continues just like all the others. It's going down. So growth is decelerating here. Same here with customers with ARR of above or equal to $1 million, but that's growing much faster. That's up 22.8% year over year. Gross profit margin here still around 77, like we've seen, $76 has come down a little bit. Free cash flow margin of 30.3%. That has been increasing actually over the past couple of years. Operating margin is improving, but we're still negative at the moment. Last thing here, and that's remaining performance obligation, that did increase 30.2% last quarter, and this as well has been re-accelerating. So that's great, and that's something that we've seen with a lot of these players, right? Revenue coming in at X%, remaining performance obligation does grow a little bit faster than that and has seen a little acceleration as well, again, indicating that there is quite a lot of momentum in this industry. But, do you want to pay a premium for these names for the sake of having exposure to cybersecurity? Because I've been getting a lot of questions. Why don't you own any cybersecurity name in your portfolio? And the answer is purely, yeah, because it is expensive, and personally, I don't need it. I will probably get it next year when Google completes the acquisition of Wiz, right? Wiz is also cybersecurity in the cloud, so it might not be competing with those players, but that would be, for example, my exposure. By the way, if you own Microsoft, you're also having exposure to cybersecurity, because Microsoft's cybersecurity, side of the business is already quite a big one. So yeah, that's basically it. It's very, very interesting companies, but you have to pay up to own them. Let me know if that's worth it down in the comment section below. Like, subscribe to all of that, and I'll see you all in the next one. Bye-bye.